Depending on the commodity, right? And we are heavy in materials relative to the index and have been for a while, will be for a while, because I do believe that commodity usage will go through the roof. Right now, China is consuming 40% of the commodities on the planet, basically. But if you look in the energy markets, for instance, oil, like I said, is at $108 today. There's obviously an Iran premium in there, but the world consumes about 90 million barrels per day, probably max production capacity is 100 million. So we're bumping up against, I think, thresholds that mean we're going to be living with high oil prices, which is going to require innovation, but it also is going to require drilling. And so if you look at the U.S. and you look at our ability to sort of now go down and sideways to suck oil out of places and the fracking and all that kind of stuff, we have enormous reserves. I used to sort of be a peak oil guy and we're going to run out of oil. But now technology has leapfrogged to the point where we can get a whole lot more oil out of the ground than we get today. What stands between us and that moment is really political choice. That's kind of where we are. So oil, yes, demand is going to rise, but thanks to technology and removing some political barriers, supply can be on the rise as well. What's extremely powerful and underreported is that natural gas is now at $2, right? Natural gas is a huge input to things like electricity. And moving off of oil into natural gas to power vehicles is something we can do. And so technology and adaptation can reconcile, I think, with some of the pressures we're seeing in the commodity markets. And so, yes, I think when you get to things like platinum and gold and other materials, specifically those with industrial uses, you're going to continue to see pressure there. But what's been really interesting for me to watch is how quickly technology is unlocking even more productivity and deeper water finds and that kind of stuff. So we have to have the political will to keep commodity prices down, basically. Great question. So, we are patriots, and so I want the U.S. to do well, but if this is not a hospitable place for our combined capital, then we'll take it somewhere else. And so, we have been much higher in terms of our overseas exposure actually than we are today. We repatriated a lot to try and adjust to the environment we saw last year, where we got down to 25, 30% overseas. We're now ratcheting that up a little bit, as you saw in that special situations piece. Right now, my main frustration is I want to own more Asia than we own right now. The problem is there's nothing in the portfolio I don't like, And so it's a relative sort of evaluation process, and U.S. companies have done a really good job of being able to go into the emerging markets with higher growth rates, manufacture earnings, and then bring them back to the safety of the U.S., where we have good laws, we have good accounting standards, et cetera. So what's interesting about where we are on the planet right now is that your domicile, in terms of where you get your mail delivered at headquarters, really doesn't determine where you're doing business. I mean, I think Coca-Cola gets 70% of its earnings offshore now. So the U.S. companies that are emerging market facing are very attractive investments, if not equally attractive to some of the companies that are located in the emerging market themselves. And so it's hard to get the data, frankly, but even though right now we're only about 35%, Mark, is that about right, international, I would argue that our companies' earnings are much more international than that. What's happening is all the lines are simply blurring. But from an asset class perspective, Europe, and I don't know if I can say this to you or not, but the European Focus Fund that we own is up 22% this year. The emerging market fund that I wish I owned that I don't own is up 18% this year, right? And so until something goes wrong in the positions that we're in, there's no need to rotate. If that makes sense.